Hey folks, top of the morning to you today. Mortgage rates went up yesterday, 0.03%. I thought it was going to be much worse than that. So what are we going to talk about today? The market is getting hammered right now. We got the MBS is down 50%. I'm going to start with the chart here in a second, but I just want to show you guys some of the news that's coming in right now. These are where rates are, 6.68 on the 30-year fixed right now. I was thinking this was going to be in the low sixes or 5.99 before the war, and that's where we were. So what's causing mortgage rates to spike up? What should you do if you're a homeowner, home buyer? That's what we're going to talk about in today's show, folks. So let's get over to it. The mortgage bond market, whoa, we got a little green there. It's getting hammered. Okay, so here's all you have to know. That number up through there, if its number's red, that is bad. If it's over 10, that's really bad. So MBSs are, you're going to see this move. I'll talk about it for a minute, but we'll see it probably move right here. It's down 50 ticks. That means mortgage rates, can they get to 6.75, 6.8 on their way to 7? Well, let's go over to it. So it's down 47. So what's actually happening in the market right now? Well, the thing is it's oil. Okay, so I'm going to go through a lot of things with you right now. I'm going to go through the jobs reports numbers with you, earnings reports. We're going to go through, you realize that the S&P 500, I think it's the S&P 500, no, the NASDAQ, it's up 20% since March. 20%. So what's going on in the market? So let's figure out what's going to go on with the interest rates, because if you're watching this, you're a homeowner or home buyer. We've got to focus in on oil, because oil is putting so much pressure on inflation. Because if we go through, as we go through the data, I'm going to show you the Federal Reserve, they look at two things. They look at jobs and they look at inflation. We got the ADP jobs report today, and I got to use some data for information. So let's get over, and here's what the Federal Reserve looks at, okay? They want to figure out the health of the economy. So they're saying, okay, inflation, where's inflation? We need it at 2%. Hopefully you guys understand why we need inflation at 2%, because it compounds every year on top of itself. It gets crazy after 5-10 years. So I think I got a blog up there for that. But the PCE, the inflation that the Federal Reserve measures, it's 3.5, it's probably 4, maybe on its way to 5. So then we look at the unemployment numbers. The unemployment numbers, they're looking really good. Okay, so anything under 5% is full employment. Well, let's get over just some economic news we have for today, but I want to take a broad brush of let's look at the economy, because that's what's actually going to trigger interest rates. So we go through it and we look at, okay, let's look at the jobs numbers. That's what came in today on the economic front. So right through here, we got ADP payroll, and last reading is 33,000. They didn't come up with estimates this time. 42,000 new jobs in a week. That's a fantastic number. Pending home sales, this just popped up. Last reading was 1.7. They thought it would drop to 1. It stayed at 1.4. Pending homes, they're doing okay. So let's go down and look at the things that basically the markets even look at to figure out where bond prices are going, because that's actually what dictates mortgage rates. I'm also going to talk about stocks, cryptocurrencies, and things like that. But let's just go over and look at inflation. Okay, the Federal Reserve, they want inflation at 2%, because as it compounds, even 2% makes things much more expensive, 10 years down the road. But even Kalshi, let's go to Kalshi. They're saying the inflation in May, the CPI, not the PCE, but basically the inflation you and I are paying, they're saying it's at 4.2%. There's a 70% chance it's going to come in at 4.2%. Okay, the Fed wants, well, the inflation number's at 2. So you have inflation at 4, double what even the markets want. So then we go over to the Federal Reserve. If you're sitting on the Federal Reserve, you're looking at this. Okay, we have jobs numbers that are fantastic. Okay, you have earnings reports. I'm going to go through some numbers with you. The S&P is up. The earnings reports on average are up about, well, they're over 20% this year. Then we have the NASDAQ. It's up, over 20% since March. And then if you were on the side of the housing crash, what happened about the housing crash? I'm going to get to that in a second. I'm going to call out the crashers here in a second. Hopefully they put their money where their mouth was. But if you look at what the Federal Reserve's most likely going to do, we're just going to look at the next few meetings, because mainstream media is telling us right now, okay, there's a 50% chance or more that the Federal Reserve is actually going to increase rates the latter part of this year. It's not going to happen, folks. Let's get over it, and I'll kind of go through the scenario with you. I could be wrong, but let's go over what my thoughts are. In 29 days, the Federal Reserve is going to meet. They're not cutting. There's basically a 100% chance they're not going to cut. Now you go through here, and it's saying, well, maybe next year in 2027, there might be about a 40% chance the Federal Reserve will increase rates. Well, yeah, if oil stays at $100 a barrel, until the end of this year. Well, yeah, they're going to have to increase rates because let's look at it this way. Let's look at the economics with all this. The average person, you and me, we've got a pay increase or earnings increase of about 3.6%. So say 3.5, right about 3.5%. Well, you got inflation at 4, even the poly markets are telling, or the Kalshi markets are telling, inflation's at 4.2. So if you're sitting at the Fed saying, okay, jobs are fantastic, inflation's way too high, well, are you going to cut? No, you're not going to cut. Are you going to cut once oil comes down and goes to maybe $60 a barrel? Yeah, but when's that going to be? Who knows? So let's get over and see, what's the likelihood of the Fed cutting? Well, they're actually going to increase rates in January. So again, this is only a probability if oil stays at its levels right now for longer. Okay, so what's most likely going to happen, it'll start to teeter, and when the war ends, just watch oil because you're going to actually see all the markets rally. Just look at yesterday. Trump tweeted, he said, I'm going to hold off the invasion or the bombing of Iran. Markets rallied. I'm going to show you a chart here in a second because we're going to end with the chart as well. But let's look at that. We look at the predictions on what the Federal Reserve is going to do. They're not going to do anything at the next few meetings. So what are we advising our clients? Should you lock in at these rates or should you wait? Okay, if I'm refinancing right now, here's the honest truth with it is I'm not doing anything yet. I'm putting my information in and getting ready because as soon as this war ends, you're going to follow oil, and as oil comes down, rates are going to come down. Find your sweet spot. I'm going to give you some tools on our website that you can do that. But if that's what I'm predicting. So get your information in, especially if you're at a rate at 7%. Get ready because they can come down pretty quick. We were at 5.99 before the war. But if you're buying a house, hopefully you heeded my advice. When you got pre-approved, at a rate maybe a quarter or 0.5% higher than what the rates are at that time. Why? Well, because if this happens, you're prepared. If you got pre-approved at 6.25, 6.5, now rates are 6.75. You put a house under contract, you didn't lock in. It's like, oh, that payment's a little bit higher than I thought. Well, not if you heeded my concerns there. So if we go over to here, if you get a house under contract, just lock it in. Lock it in. You can't afford rates to go up like today. It might go up, we're now down 50 ticks, might go up 1/8% today to 6.75 on the way to 7%. Can you afford it at that point? Well, I mean, probably not. So if you're looking to buy in a few months, you're looking to build, what should you do? Okay, so here's my advice. I'm still saying it. The rates are going to eventually teeter off. And I know I keep saying that all the time. It's all on the Iranian situation. Okay, so once that ends, and I didn't even think, and most analysts wouldn't think, that this would have lasted this long. Once it ceases, watch that oil. Probably it's going to take a little bit longer to reprieve down from its levels where it is now, but watch that, and you're going to continue to watch interest rates drop. This war isn't going to last forever, so it's eventually going to get here. So what I would do, I'd get pre-approved. Make sure you're getting pre-approved at 7%. Because if you can afford it at that price, well, then you can afford housing. If you can't, you might want to put things off for right now. A little confused on how much you can really afford. Let's go over to my site real quick. So one before I go there, I'm actually calling out the crashers today. So if you're watching this video, I get a lot of referrals from these guys over through here. So for all the house crashers out there, did you short the home builder stocks? So here's what that means. So these guys right here, they make a living every day coming out and telling us how bad the market is, and it's going to be worse than 2008 every year since 2022. Okay, so what has happened to home builders? They keep coming out and saying, okay, the housing builders, they're going to go bankrupt, and they're slashing these prices. So, okay, so are you making money on it other than on YouTube? Let me explain how this could work. So if I know the housing market's going to crash, what do? Well, I don't buy real estate. And a lot of these guys say, don't ever buy real estate. It's the worst thing. And then put your money under a mattress. Well, here's a way to invest in this. Go into these home builder stocks if you think they're going to go bankrupt and short them. Okay, what shorting means is you're buying the stock hoping it goes down. Okay, so if they did that, how'd they do? Well, again, I don't really think these guys believe this stuff. They just make a lot of money off of it. So if you go down through here, here's home builder stock since 2021. So yesterday we had the home builder sentiment. It actually came in better than it was expected. And the people were saying, okay, how can that be? Well, let me just show you some things. If you go down through here, this was a little jumbled, and I apologize. I had this as a website, and then I blogged it. But all you have to look at is right through here. Okay, D.R. Horton, its stock in 2021 was $72 a share. Okay, if you shorted it, hopefully it went to zero because you make $72 a share. What did it do? It went to $146 a share, and that was its price just, I think, last week. 101% increase. Let's go to Lennar. These are the top home builders out there. So people keep saying D.R. Horton and Pulte and Toll Brothers. Well, Lennar, they would have only made 26%. So if you invested in Lennar housing stock in 2021, you'd be up 25%. Not bad. Well, if you invested in Pulte, you'd have a measly 185% return. How about Toll Brothers? That's another biggie out there. Well, you would have only made 183% if you long the stock, meaning you just bought the stock hoping it would go up and the companies would survive. So if you shorted these things hoping they went to zero, this would have been your returns over through here. You would have lost a lot of money. So do they really believe this? I don't think so, but they're probably most likely in a bubble. But the housing crash of 2008, hopefully we never have that again, and hopefully you understand what happened in those times as well. But home builder sentiment is up, and it's actually beating the forecast, and you got a lot of data coming in right now. So am I giving FOMO to housing? Absolutely not. I'm just giving you the realities behind this. So you have to really focus in on your market. I don't know what your market's going to do. I live in Chicago. My market, I live in the suburbs. It's actually up. I did a study the other day. It's up. We're up about 17% in the last 2 or 3 years. I'll take it. Okay. And then we have interest rates that are working for us right now. Rates about a year and a half ago, 2 years ago, were 8%. I think we're on our way, maybe closer to 7. We were at 5.99 previously. So if you want to find out a whole bunch of tools that I have, folks, just go to my website. Here's a site that we have. It should be down below. It's standstore.com. You can find all kind of tools here. If you're a loan officer, realtor, even a consumer out there, look down through here. The True Payment Calculators. I created this thing. I just launched it yesterday. Check it out. It's right through here. If you really want to find out what your real payment is and what your real rate would be, your rate. You can click right through here and actually go into our RateWatch system and actually look at what your current rate would be. And if you like it, you can click ahead, and it'll automatically link you to my team. We get you locked in. So we got a ton of tools here for you, but let's go back. And the economic calendar, like I said, for today, ADP payroll come in, and that came in pretty darn good. Pending home sales came in better than expected. Tomorrow, we don't have much coming out of other than the FOMC meeting. That's the Federal Reserve meetings. Their notes are coming out. Don't really think we're going to see much there. There was a lot of dissension, but you got to remember, Federal Chairman Powell, he's no longer sitting in that chairman's seat. We have Warsh, who's going to be sworn in actually this Friday. So Warsh will be coming in. But then on Thursday, we're going to get a lot of information that could actually sway the market, but I think the markets are basically concerned right now about the Iranian situation and inflation. The longer this lasts, the worse it's going to be. But initial jobless claims are supposed to come in on Thursday, as well as continued claims. We're going to see if you lost your job, were you able to get a job back? That's going to give us a big read there. Housing starts and so forth. But really, this week, there's not that much there. Last week we had inflation numbers. The previous week we had the jobs numbers, and they were all really good, except those darn inflationary numbers. They're just skyrocketing at this point. So what would I be doing? That's what I would be doing. I advise you on my locker floats. So let's get back and end this thing with the charts. So the chart now is down 51 ticks. This is a bad Tuesday, folks. So if we go to a 2-day chart, here's even worse. See the gap right through here? Okay, that means usually, hopefully fills. Okay, so here's what happens. If you're watching the charting, here's what we watch. As this price goes down, this is the price of a bond. Okay, if it goes down, the yields go up. So we don't like this. This means mortgage rates are going up. What happens every once in a while, you'll start and you'll see that gap over through here. It closed here and open here. Usually the gap fills. Don't ask me why it happens, but usually it fills. So we're hoping it fills. But if you look at a 5-day chart, down, 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 and away, and this isn't good. So how far are they going to go down? Well, basically then how high are mortgage rates going to get? I've been predicting 6.25 to 6.5 during the war. I've blown it to this point, so let's move our estimates up another 0.25% and say, it can go to 6.75, but I'm telling you, once this war ends, I think we're going to see a lot of action in the markets in a good way. So if there's any questions out there, let me know. If you're out there looking to buy that first house, we have a lot of tools for you. If you're a homeowner, do me a huge favor. Go to my website. Here, let's find it over here. I'm just going to go to therateupdate.com. And what I need you to do is just go right through here, and it's called RateWatch 2.2. Put in your mortgage information in here. Give me 2 pieces of information that you want me to track for you. At what rate would you be interested in refinancing? Just so we can go through the numbers. Not a hard sale. I'm just going to go through your costs, your break-even point, and we'll contact you. But the cool thing is we have with 2.2, you can actually plug in how much of a month you have, how much of a monthly savings you want. You haven't realized right now, well, about 2 months ago, the average person was reducing their rate by 1.3% and saving over $500 a month. You want to check and see how much you can save? We'll put your information into here. We have a lot of other tools up through here for you as well. So that is it for the day, folks. The bond market is down now, minus 52, which is not good news. And I also more not so good news for you. I need you in my prayers, if you would. My brother-in-law, the hits keep coming. My brother-in-law just got put on hospice last night. He's suffering from cancer, and they don't give him that much longer to live. So prayers for my family. My wife has gone through this so far in the last 45 days. She lost her uncle. Then my mother passed on Easter, and now her brother is on hospice. So prayers for us if you don't mind. I would truly appreciate it. So that is it for the day, folks. The stock market, let's get over to see where the stock market's going. It's all in the red across the board through here, and it's all on oil. So this is an un-Cinderella story, folks, for you today. We got oil up, all the other markets in the red, cryptocurrency, and it is red too. So we have an un-Cinderella story for you today, folks. Sorry for that, but come back tomorrow, and I'll explain to you guys what's going to go on with these and the whys behind it.